In this voiceover, we're going to be talking about the issuance of stock and the repurchase of stock, and then after we've repurchased it and put it into treasury stock, what happens when we resell that stock that was in our treasury. So it's stock transactions in this voiceover. One of the terminologies that we kind of glazed over in our previous voiceover was this par value and the concept of par value. And par value, it really doesn't mean anything. It is just kind of an arbitrary number that we use in our accounting. And companies don't even have to use par value. And some stock is no par value stock, and that means there's no par value associated with that stock, and it's not into the accounting system. We keep track of par value because we're going to use the par value in how we account for the sale of our stock. It's an arbitrary number then, and it has nothing to do with market price, but I'd say that market price goes up and down, it moves around, the market price of a given share of stock will change. Par value does not change. It is a set amount that stays at its value. Now, when we talk about stock splits and we talk about dividends, then we may discuss par value changes. But for now, just know that par value is just an arbitrary amount, but we're going to need to know it when we start talking about the issuance of our stock. And some states then do not require par when they have a charter or the corporation is authorized, and so we don't have to worry about it at all. In this instance, though, we have the issue of stock, and the issue of stock is that the stock is being sold in the marketplace, and it's sold for $20 a share, and the par value is only a penny per share, and so par value really doesn't have any meaning other than it's a number that's established. The $20 happens to be the stock price on this given day when it's sold. So what we have to use this par value for is to use it to determine the amount to put in our common stock account and the amount to put in this other account called additional paid-in capital. So recall from looking at the balance sheet, we had in our contributed capital section a caption which said additional paid-in capital. Oftentimes this is abbreviated PIC, and also it's commonly said to be PIC-common stock, because when we get to the preferred stock transactions, we can also have paid in capital for preferred stock. So paid in capital is the amount of the value of market minus par times number of shares. Common stock is going to be credited for the number of shares that are issued times the par of a penny, and that's how we come up with 1,000 here. Paid in capital is going to be the difference between $20 minus the penny, so $19.99 times the 100,000 shares gets you this number. The total amount of cash they're getting in is going to be the market price per share times the number of shares what they issued, so it's 2 million. So we have something that's kind of an arbitrary thing here, which is dividing up the amount of contributed capital into these two captions, common stock and paid in capital. It's something that you just memorize and how to find these numbers. Really has no particular meaning to us. Now we need to talk about the repurchase transactions and why a company might repurchase. One of the major reasons, I would say, they list a number of items here, and they are all valid reasons for repurchasing stock. But if a company takes shares of stock out of the marketplace and there are fewer shares traded, then the stock price tends to go up. So if you wanted to increase your stock price, something you might consider doing would be buying back the number of shares. Another thing that it does is when we calculate earnings per share, and that's going to be done in the last voiceover in this PowerPoint, in PowerPoint 11. When we calculate earnings per share, if we have fewer shares outstanding, then earnings per share will go up, and earnings per share is an important metric. So fooling around with the number of shares held in the public with the public will have an effect on the company. So the company may want to buy back their shares to reduce the number of outstanding shares, to increase stock price, and to also increase earnings per share measures. So here we have National Beverage Corporation, and they're going to buy back 50,000 shares of common stock at $25 per share. I want you to note right now that it does not matter what par is in these repurchase of stock transactions. So in treasury stock transactions, you do not need to know what par is. The only thing that's relevant here is the price of the stock and the number of shares. So 50,000 shares times $25 per share is going to be a credit to cash and a debit to treasury stock. And notice they're using this caption and calling it a contra account. I'm not really comfortable with calling it a contra account because generally when we talk about contra accounts, it means that we talk about the main account, we have to talk about the contra account. So when we talk about, for example, fixed assets and we have equipment, we would have had to talk about accumulated depreciation with the equipment. There's no requirement when we're talking about the common stock that we also talk about the treasury. We don't even really show it right next to common stock. We have it in a separate category. We don't even have it in the contributed capital section. So I'm not too comfortable with calling treasury stock a contra account. I think what they're trying to tell us here is that it does have a normal debit balance. Instead of having a credit balance, it has a normal debit balance. So if you if you like looking at the accounting transaction and thinking about it that way, the left side goes down, the right side goes down because stockholders' equity normally has a credit balance and the credit is being reduced by the debit to treasury stock. Now we have to note also that when we're buying back treasury stock, we are not debiting common stock. We are debiting treasury stock. So it gets a little confusing here because when we buy and sell a particular asset, you're going to debit and credit the asset, right? But when we're buying and selling our common stock, when we first issue it, we debit cash and we credit common stock and paid-in capital. When we take it into the treasury, we're not debiting common stock. We're buying it back, but we're not calling it common stock anymore. We're calling it treasury stock. So we're creating this new account called treasury stock and we're putting it in there. There's no paid-in capital associated with it at this point. We are just putting it in our treasury and we're calling it treasury stock. Another thing that's confusing to students is students like to call this an asset and they like to think of it as investing. No, we cannot invest in ourselves. We can invest in other companies but not ourselves. So we have to call it an equity account. It's just an equity account with a normal debit balance called treasury stock. Again, there's no paid-in capital, there's no par, no thinking about par on this stock at this point. We are just buying it back and we're putting it in at its cost, which is $1.25 million. If we turn around and sell this and we had bought it at 25, we're going to take it out of our account at the amount which it was put in at. And in the previous transaction, there were many shares which we bought, and we are only going to take out of our treasury, though, 5,000. So we put a number of shares in our treasury, and now we're going to take them out of the treasury and send them back to the public. When we send them back to the public could either pay us more than the $25 which we paid to buy back our shares, or they could pay less. In this case, they paid $3 more. We don't get to call this difference as a gain. No gain can be recorded on buying and selling of our own stock. I'll give you a reason why we can't record a gain in this situation. You recall 9/11. It was a terrible event in our nation's history. And what happened after 9/11 is the stock market crashed. The stock market reduced all the prices in general, and the stock market went down. If a company could record a gain or loss, then any time we would have an event like this, all the companies would go out and buy their own stock because the stock prices would have gone down, and they would hold on to them for a few months, and I think it's probably 3 months' time for our stock market to recover, and then they would sell them and they would record the gain or loss. Where does the gain or loss show up? Where would this gain have showed up? It would show up on the income statement. So they could make their income statements look good by waiting for a dramatic, terrible event to happen, buying back their stock off the stock market, and then selling it after the stock prices in general recovered. So they would be manipulating their financial statement by buying and selling their own stock. This would not be an earned process. This would not reflect something the company had done, an earnings process. It's manipulative is what it is. And so we cannot do that. It's rather unethical when you think about it. So additional paid-in capital or paid-in capital account is what we are going to credit. We're going to put it in a paid-in capital account. And as I said before, it would probably be paid-in capital with a caption after it. This case would be treasury stock. Now, is this still a good thing for the company? Yes, it's still a good thing because we paid 25 for something and we sell it for 28. So yes, our cash account goes up by $3 for every share that we have now sold. So in effect, in this transaction, you see we've made $15,000. Our cash has gone up. We can't call it revenue though. We can't call it a gain. We can't call it an income statement item. But we are financially better off because we have $3 times 5,000 shares or $15,000 more in cash than when we made that purchase.